For investment funds, the explosion of investor interest in sustainable finance and investing has led to a massive increase in ESG-related investment funds around the world. However, the lack of a robust disclosure framework has also revealed that investment funds can also mislead or misrepresent themselves as being ESG-focused investments. The Financial Times references a report from Influence Map, which found that out of 593 ESG equity funds it looked at, 421 of them were not aligned with the Paris climate targets, despite the fact that 3 out of 4 of those funds had marketed themselves as Paris aligned. Another Financial Times article pointed out that Morningstar had removed over 1,200 funds with $1.4 trillion in assets from its sustainable investment list after an extensive review found ambiguous language in their disclosure documents. The Economist looked at 20 of the world's largest ESG funds and found that the funds held, on average, 17 fossil fuel producing companies. Understandably, securities regulators around the world are concerned about investment funds misleading investors about their true extent and focus on ESG-related matters. Here in Canada, as part of the work included in the Canadian Securities Administrators Staff Notice 81334, ESG-related investment fund disclosure, regulators had reviewed 32 funds that referenced ESG in their investment objectives or marketed themselves in their online sales communications as ESG-related funds. For each fund, regulators looked at the fund's prospectus, annual information form, fund facts or ETF facts, and online sales communication. The findings can provide some insight for fund companies on things to avoid while providing advisors and investors some things to look out for.